You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is not Education Wednesday. It's actually Pro Q&A Tuesday. So we're doing a little bit of an early dose of Options Bootcamp, coming hot on the heels of an excellent Pro Q&A out there with Mr. Ewan Sinclair. You're probably familiar with him from a lot of volatility-oriented books he's written over the years. Great one there. We got another one coming up a little bit later today with the Spikes father himself, Mr. Simon Ho, creator of Spikes Volatility Index, a VIX competitor, as well as BitVol, a.k.a. kind of the Bitcoin VIX. So a lot of great vol-oriented Pro Q&As. If you got your questions, if you haven't signed up for Pro yet, first off, what are you waiting for? Man, you're missing out on a palooza of content. B, if you sign up after the fact, you can still get access to all that good stuff. We have a cool Pro Q&A podcast just for our Pro members. If you sign up for that, you get access to all that stuff. So even the ones you missed, you can tune into those and enjoy those at your leisure. And, of course, going forward, you can participate in all of our Pro Q&As, and your questions get bumped to the top of the list for shows like this and all the other fun stuff that we do here on the network. So you know where to go to learn more. TheOptionsInsider.com/pro is the place to go. Trust me, a lot of cool stuff there. Glad to see so many of you have joined and are having such a ball with it and getting a lot of value out of it. Tell you what, secret, we're having a ball too. It's really just been a fun time. Glad to see so many people enjoying the trip here, enjoying the journey. It's a fun one. Don't forget Options Oddities every Friday as well. Another little nugget we throw out there for you pro folks out there. So a lot of great fun to be had. TheOptionsInsider.com/pro is the place to go. And of course, however you listen, if you're on the pro side, listening live, listening after the fact, keep those questions and comments coming. If you're listening after the fact on whatever device it is, make sure you keep rating and reviewing in your platform of choice. Does help all those new folks who are kind of coming to options and saying, man, these things are crazy. And hey, I'm with you. They are crazy right now. So help them find a path to this door. Hopefully that will keep them around a little bit longer. Help them become a more successful long-term options trader. Of course, keep those questions and comments coming too. We do love to hear from all of you guys and gals out there. And let's see who we're hearing from on ye old program today. I am pleased to be joined once again by the black-hatted one himself, Mr. Dan Passarelli, a.k.a. the founder of Market Taker Mentoring. Mr. P, welcome back to the program, sir.
Yeah, hey, man, I'm pretty excited to be here. This is going to be great.
Yes, it will be great here as we keep on rolling right on into actually, before we get to the basic training and all the other fun stuff that we do here, Mr. Dan, I do like to give you this opportunity to kind of pick your brain. It's been, shall we say, a little bit of tumult in the market since you and I gathered here together on the Options Bootcamp Drill Instructor Proving Ground last, including a pretty aggressive sell-off yesterday. It seemed like a lot of that was driven by some COVID fears, maybe some energy and some yield concerns going on in there as well. We're rebounding off of it pretty firmly today, but still a little bit of a shock to the system, the most aggressive sell-off of the year, at least if you look through the lens of some of the equity indexes like the Dow. What was lighting up your tape as we saw all this madness unfold yesterday, and what was going on in the land of MTM, sir?
Well, I mean, a big part of this is the COVID scares. Like, those of us who've gotten vaccinated, I'm going to the grocery store, no mask, feel pretty liberated. And, it doesn't seem as fearful as it was. But for a lot of people and for a lot of other countries, there's some bad stuff happening. And I suspect that we're going to keep seeing market volatility, and we're going to keep seeing days like this days like yesterday, and maybe some follow through on those future days until we get this stupid damn COVID thing under control. And I don't know. I mean, I guess just looking at it pure trader predatorially, it's nice to have those opportunities, but they can be kind of dicey as well. So, I don't know. I guess that's the assessment. I sense that as long, until there is this herd immunity achieved, that we're going to have some volatility happening.
These are tough markets to weather these days, Mr. P. Folks are probably flocking to a service like yours right now. You've been mentoring people for a while. You've seen a lot of people come and go in these options markets. I'm curious for you, now that you've kind of been down this road, been there and done that a little bit out there. What do you think is the biggest thing? If you had to quantify one thing, one standout feature that you would say kind of separates the wheat from the chaff, someone who you can look at and say, okay, this person's going to make it. They're going to be, maybe not instantly wealthy, but at the very least, a successful longer-term options trader, then this guy is going to go the way of the dodo pretty quickly. What would you say, if you could quantify or codify that, sir, what would it be?
I would say that probably the biggest thing is just taking action, moving forward, and continuing to move forward. There's a lot of folks who, they kind of look at it and they think about it some more, and they'll send me an email and they say, yeah, I kind of want to learn about this. And they think about it. And some of them never get past that point. Some of them actually get started. They dip their toe in the water and then they lose and they say, this isn't for me. Some of them, take it even further than that and make a few trades. And that's kind of the worst case scenario, where they just sort of tread water and figure one day it's just magically going to work. But the people in our community, the market taker mentoring community that I see that have had the biggest successes are the ones that kind of approach it a little more, I want to say fearlessly, but I don't want anyone to misinterpret that by saying, just trade crazy stuff. I mean, fearlessly in that they say, yeah, I'm going to make this happen. This is for me. I'm excited. I'm going to follow through, do the things that I know I need to do in order to make this happen. I'm going to keep going, keep moving forward, keep learning more and more and more until it works. And I guess that can be said about anything, not just trading, but you definitely see that in trading for sure.
And now let's see what we see as we move on into our basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Pull in, print bear to learn.
All right, everybody, welcome to Basic Training, the portion of the show where we break down some basic options, concept, or technique and explain it to you in a little bit more detail how you can utilize it in your trading. Today's concept may be a little bit more advanced, Dan. It seems like a lot of people have this one particular thing on the brain these days, so it seemed like a good time to revisit it a little bit here. This question that kind of inspired this came from DKX. He wanted to know, is the Skew Index a good measure of future tail risk in the S&P 500? Good question, DK. We had a lot of Skew Index questions lately. We'll get back to that in a second. We're just coming off, like I said, a great pro Q&A with Ewan Sinclair. Check it out if you are on the pro side, if you couldn't join us live. We had a lot of questions along a similar line. People have Skew Index and or Skew in all of its myriad forms on the brain these days, Dan. I guess it's kind of hard to blame them. Look at what we're seeing out there. GameStop kicking it off, then AMC, and then kind of pick your meme-oriented name. We were taught forever that this type of skew really doesn't and or shouldn't exist in a lot of single-name equity options. The call should be cheap, the put should be bid, and yet what we're seeing is, at least on the call wing, kind of the exact opposite in a lot of these names out there. So maybe we should start by dialing it back a little bit for some of the beginners here, Dan. When we say volatility skew, what the heck are we talking about?
Well, Mark, so look, options are priced with some regard to expectations of future volatility. Now, I'm saying that very, very broadly because if you start getting more specific, we can start poking a lot of holes in that. I believe, and I think anybody who's traded a long time or who's studied this believes, the market is not extremely efficient in pricing in volatility. There is a correlation, but it's not a strong correlation. There's some disconnect for sure. And so that being said, the implied volatility, which is what we're talking about, is really based off supply and demand for options. The sort of like overriding assumption is that if people are buying options, they're buying options because they expect higher volatility, which there's some truth to that. And if they're selling options, is that they expect lower volatility in the future. And there's some truth to that, but it's not as, in my experience, it's not as mathematically accurate as, as you could be led to believe. So that said, if you look at any stock or index or ETF, like there's lots of different strikes listed on it, right? And if you put implied volatility in the option chain that you're looking at, which every single person who's been listening to the show for a while ought to be doing, you'll notice that there's actually a different implied volatility for each strike within any given expiration. And there's some methodology to it. There's sort of a smoothness to the curve if we were to plot that. And that's logical. They should be, because there's some sort of semi-fungibility among the different strikes. So that's what skew is. It's that observation of a different implied volatility at the different strikes within any given expiration for any given underlying.
There you go. Well said, sir. Quick history lesson out there for all of you who may be wondering how all this got started. For a long time out there in the early days of options, well, first there were no puts, there were only calls. Eventually puts came along. And for a long time, the market really kind of priced them in a similar way. They pretty much applied the same vol level to the calls as they did to the puts. So they had what would typically be known as a smile. If you graphed out those levels of implied volatility with your intersection of the axes being your at-the-money strike, you go above it to the call wing, you go below it to the put wing, you'd see a smile shape. They were pretty much priced at the same level of volatility. And then what happened? Well, 1987 rolled around, and a little bit of a crash happened then. And then all of a sudden, people who pay attention to such things started saying, you know what? The way these options performed in the real world is a heck of a lot different than the way we've been modeling them for a while. Maybe we should rethink that. And that's when the concept of skew was born, where they started to say, wait a minute, maybe these puts should trade at a higher level of implied volatility, and maybe the call is a little bit less. And that's kind of the way, over time, it was effectively the supply and demand of the options market that really dictated this, and that's kind of how skew has shaped up. For a lot of what you guys see out there, you're looking at your major indices, your S&Ps, your NASDAQs, and most of your major single-name equity options, so your Apples, your Teslas, and we can maybe lump AMC in there, but even though it's kind of a weird, it's its own beast right now of GameStop, so maybe we'll keep the meme stocks separate. But most of your normal equity options trade under a similar skew-type pattern, and that's called investment skew. And what does that mean? It means effectively, like Dan was saying earlier, the call wing, the implied volatility levels in the call wing, so options above the at-the-money strike, are going to be traditionally lower because there's a lot of, think about it, most people out there are long the equity market, right? So what are they doing against that? They're typically selling covered calls, So that depresses the volatility levels in that call wing. And they're also buying puts to hedge it quite often as well. So that means when you go below the strikes below the at the money strike, aka the put wing, you're going to see relative levels of implied volatility that are typically higher than what you're seeing in the call wing. So that's what we mean by a skew. If you were to graph that out, it has that nice skew shape. And that's what most people are going to encounter when they're out there in the marketplace. Now, that's not the only type of skew. If you listen to our show like TWIFO, This Week in Futures Options, you'd see typically commodities, ags, metals, energy, whatever. They could trade in all sorts of different types of skew. If there's concern or explosion to the upside, you could see a huge bid to the calls in commodities, and no one maybe wants to touch the put, so it's completely the polar opposite. Sometimes there's a smile. You don't know which way this thing's going, so both wings are bid. So depends what kind of underlying you're looking at, what type of skew you're going to have. But for most of you coming to this show, getting started with equity options, you're going to encounter traditional investment skew. Now, how do we measure that traditionally? Well, there's usually a pretty standard metric. It's sometimes called a 25 delta risk reversal. I don't know why. It's really a 50 delta risk reversal. I don't know why everyone calls it a 25 delta. I mean, I could see why, but it's not accurate. Because, of course, you're looking at the 25 delta call, and that's usually going to be a nice kind of sweet spot in the middle of that call wing, listeners, and also the 25 delta put, also going to be in the middle of that put wing now. And what you're going to do is, if you're looking at skew, it's a risk reversal. You're going to sell one and buy the other. You're trying to effectively reverse the skew risk of your position out there. So in the case of if you're selling a 25 delta put, remember that's a negative delta on a put. So you're selling a negative, that's a positive. And then you're buying 25 delta call, that's another 25 deltas. Add them together, that's 50. Vice versa, if you're selling it, you're selling the call, buying the put, negative 50 deltas. Either way, it's that 50 delta risk reversal. That's usually the framework most people use to evaluate skew. So Dan, anything to add on that, kind of the history of skew, the use case of skew, and also do you use your traditional 25 to 50 delta risk reversal, or do you have some other way of analyzing and measuring skew?
Well, no, I mean, I look at it I look at it very case by case, because like different stocks are going to have very, very different, very, very different tail risks. And I mean, the ideal way to look at it, especially if you're trading pretty large, I mean, I would say for smaller traders, a lot of this gets lost in the weeds. But like larger traders, when you and I were market makers, I would certainly always be looking at what we would call the volatility slope, the call slope and the put slope, and just really kind of track that. And that becomes a really good opportunity when they get out of line from what's historically normal.
All right, and another thing I want to clarify too, because I've seen a lot of people conflating skew and term structure, Dan. So maybe why don't you compare and contrast those a little bit for our audience?
Yeah, it's funny, the words that people use for certain things can be different in different areas of our industry. I mean, I would say technically we can use the word skew for, like we've been talking about what I would very technically call vertical skew, which is the skew among the different strike prices. Term structure of volatility, I've heard people call it horizontal skew, and I think that's okay, or time skew. I always like to use term structure just so there's no confusion at all. But what term structure is where the skew we've been talking about, vertical skew, that's all the same expiration but different strike prices. Term structure is all the same strike prices, but different expirations. So typically we would look at the money option, call or put. The implied volatilities are often the same, unless there's some hard to borrow or some other issues, dividends pending, ex-date rather. And we look at the monies, and we look at that over different expirations. And there's a lot of information and a lot of opportunity that can be gleaned from looking at that too, that horizontal skew or term structure, to avoid confusion.
Yeah, I've heard people throwing that around, and technically you can use it at a horizontal skew or a time skew. I find that's just very confusing to people, so I like to delineate them very clearly. Skew is your vertical 1 month implied volatility chart versus term structure, which is going out and typically looking at your at-the-money volatility across a broad cross-section of months there, so you could see how things shape up. And that's where you start getting into your time spreads and looking at some of the impacts like earnings effects, which we just talked about on the show not too long ago. You want to start lining up your calendar spreads around earnings. You're going to look at the term structure, not just the skew in the individual months. Just a little bit of clarification out there for anybody who's confused by the terminology. And now, Dan, we just set it up. We talked about investment skew. We talked about term structure. We talked about the origins of skew, kind of how this thing came about. You know, what can we do with this knowledge now? What's the point of knowing about skew? How can I take advantage of that in my trading?
Well, I mean, there's a few different ways, right? One is look, whenever I make a trade, I'm always looking at the volatility, and I start with the volatility chart, but that's just a starting point. I always look at the volatility of the underlying specific option, of the specific option in the option chain. And so in times when the skew increases, whether it's for the calls or puts, more commonly puts, that often creates an opportunity to sell some overpriced options. And arguably, there's often some bit of an advantage to selling put credit spreads rather than call credit spreads because you just get more for them. A lot of that is mathematically justifiable because we tend to see more extreme moves to the downside, so they arguably should be higher. That's why the demand is there. But just like volatility in general, it's a lot of the time, I would say most of the time, overpriced. There is a risk premium in the volatility market, but then skew can add yet more of a risk premium, or at least a different kind of risk premium. So to me, I would say for me, the best answer to that question is that it creates more opportunities, a lot of times for selling options, but sometimes for buying options as well.
It does indeed. And so typical ways you could take advantage of it, typical strategies. I mentioned the risk reversal. That's kind of your cliche, stereotypical skew type trade. It's designed to take advantage of and trade around the skew. That comes in two different flavors. There's your bullish risk reversal, which is your selling. It doesn't have to be a 25 delta. That's just your standard setup. It can be whatever delta of a put and a call you tend to like. People sometimes like to do collars in the zero cost variety. We'll get to those in a second. That means you're going to move around those strikes quite a bit to get to that zero cost variety. But your typical bullish risk reversal is a trade I often like. It's going to end up selling some sort of out of the money puts. You're getting some sort of positive delta there. Then you're going to buy some sort of out of the money call against it. And now you're having some approximation, some bullish type position. Depends what type of options you're trading. It could be, 35 delta. It could be a 75 delta. And now you have some approximation of a bullish position in that underlying without actually putting out the outlay for that underlying itself. So it's an attractive position if you want to do that. And of course, if you have a position where, let's say, the puts are very rich, the calls are cheap, that can make it favorable to set something like that up. We have seen many times in history out there in the commodities, not to go back to those again, but they have often in the past set up to be very favorable for the other type of strategy that is a very common way to trade skew, which is the bearish risk reversal, also known as the collar. That's, of course, when you're using it from a collar perspective, usually it's you have an underlying position, and then you're going to sell a covered call against it, and then use the proceeds of that to finance some portion of a protective put. Again, if you're doing it in an equity, you're still going to have to probably pay a debit for that because the put, as we just mentioned, is going to have a higher implied volatility level than the call. Versus now a commodity, we had it, soybeans and others have exhibited this in the past where you could have a market premium to the calls and the puts are kind of negligible. So you could put on collars in some of those environments for fantastic credits. It's a great, great time. But that's not all the time. Those are very rare scenarios out there. But those are the two most common, most stereotypical ways to trade skew. There's your typical bullish risk reversal, selling an out of the money put, buying an out of the money call, and your bearish risk reversal. If it's done against underlying, it's a collar, which is, of course, selling the out of the money call, buying the out of the money put. Mr. Dan, anything to add on strategies you like to use to take advantage of skew, sir?
Well, I mean, I would say for a typical retail trader, which I'll lump myself into that category these days as well. I don't have a professional account anymore. It's all a retail account. I would say just looking for those opportunities when the tail implied volatility just gets, I mean, usually the opportunities I identify is when the volatility gets extremely high. And we see that in more extreme scenarios. And I mean, look, one of those scenarios was last March, right? When we had the coronavirus crash, as the market was falling, as the market continued falling, as the market was really falling and everybody was freaking out, the puts just got ridiculously expensive. I mean, all options did, the calls did too, but the puts got even more ridiculously expensive. You looked at that volatility and you're like, wow. And it was there because of the fear. And the fear was somewhat justified. I mean, at some points, it got to the capitulation point where it could really only go up. But I mean, I did a lot of put selling during that coronavirus crash just because the puts were so darn expensive.
I think your dog did a lot of put selling too, sir. Sounds like they're very excited by that concept. Yeah, so like I said, the stereotypical cliche skew trade is the risk reversal, but anything that takes advantage of what we're talking about here, these bids or offers to the call wing or the put wing, is a skew trade. So it could be a pretty wide vertical where you're buying something nearer to at the money, selling something farther out of the money. You could see how in a name like AMC or GameStop, that could be an attractive thing because the out of the monies are extremely bid relative to the nearer to the at the money type contract. So that sets up verticals at attractive levels maybe you couldn't get before. Dan was talking about out of the money puts there as well. That's also implies you're taking advantage of a healthy bid to the put wing there. So anything where you're trading around those bids or offers to the extreme levels of the call and put wing is a skew trade. But your basics are going to be your risk reversals, your collars, your wide verticals, and that sort of thing. Dan, anything else to add here on skew, or perhaps your dog has something to add before we get some of the listeners back on here, sir?
Yeah, she gets really excited when we talk about skew, let me tell you.
Hey, who doesn't?
Yeah, well, let's see what's next on our menu here.
All right, well, let's really quickly, before we roll out of here, we should pay off the question that kicked it all off. This question from DKX wants to know, is the skew index a good measure of future tail risk in the S&P 500? I suppose that depends how you're using it there, DKX. If it's your only tool in your toolbox for analyzing skew, you have no other means at your disposal of doing so, and you're solely reliant, you're a blind man in the dark, and your only beacon of light is the skew index, then yeah, I guess it's better than nothing. That's kind of damning it with faint praise, and I kind of mean it that way. We just had this great conversation about this with you and Sinclair in our Pro Q&A. I'd encourage you to check it out at DKX if you're not on the pro side already, because we get into this in some pretty impressive detail. But in general, it's not that reliable of an indicator for a variety of reasons we don't really have time to get into. My main problem with it is that it kind of takes the useful information in the call wing and the useful information in the put wing. Remember, we just talked about that with the skew, and it kind of mashes them together and comes up with some vaguely obtuse number, which is meaningless for most people out there, unless you really dive into it. And also, I think they still disseminate it only once a day. So it's an end-of-day measure, and that's it. So that already has very limited utility for most people out there. It's not intraday at all. You can't really trade around this thing. And then on top of that, they hit this number, 150. What does that mean to you? Does that mean the puts are bid? Does that mean there's something going on in the call wing? You need to be able to separate those out to really get some sort of meaningful signal in the noise. And unfortunately, the skew index doesn't do that. It mashes them together. Dan, what are your thoughts here on the utility or perhaps lack thereof of the skew index?
I think just like volatility is not necessarily a great predictor of future volatility, I think skew is often mispriced, and it's arguably more mispriced than just volatility in general. A lot of people made a career out of this. Nicholas Nassim Taleb did. The tails, right? So we're talking like 2 and 3 standard deviations away from the center, right? those are typically significantly higher than they should be. That's called leptokurtosis, and that's just sort of a thing that's been observed in the markets for a while now. And in part, they should be a little bit higher than a typical log normal distribution dictates, but they're priced even higher than they should be. And so, yeah, like Talib, there were some guys on the CBOE trading floor back in the day. What were their names? Stafford guys or something. It was a father and son duo. And they had a model where, like, just every once in a while, they'd walk into the pit and they'd say, okay, what's the market? And these, like, way out of the money calls or puts. And they would just, buy hundreds of them. And sometimes it worked out and sometimes it didn't. It was sort of one of those swinging for the fences plays, or more accurately, black swan plays, where they know they'll lose one out of every 5, 10, 20, 50 times. Doesn't matter, because the one time they hit it big, it really pays off because they're buying underpriced lottery tickets.
Well said, sir. Man, we went longer on Skew than I thought, so fascinating conversation. I got a feeling we'll have more to discuss on this, but I want to get a few more of you on here. Really quickly, let's get into a little bit of your mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Let's do it. Let's get into the world of all things. There we go. Let's get into the world of all things questions. First off, we've got a regular listener, J3 Dingle. He says, Mark, there is no justice in this world. Yes, Robinhood paid a $70 million record fine, but they are now supposedly worth billions and looking for an IPO. The FINRA fine is just the, quote, cost of doing business, and the calls are way cheaper than the puts. Yeah, unfortunately, J3, you are correct. It does seem that that is the case out there. We kind of mentioned this on the show. They seem like they're willing to pay these record fines, and doesn't really slow them down at all. It's just kind of clearing out any quote-unquote regulatory risk that they may have on the way to their inevitable exit, their inevitable IPO. And it does seem like that's coming out. I think they have a price range. They've announced it recently as well. So it seems like nobody cares that they've been, shall we say, doing poorly by their clientele out there. We'll see how this IPO shapes up. If this does work out or if it does tank. I mean, at the end of the day, they still are getting their exit, right? So I guess that's not really going to hurt them in the long run. But you're right. It is a little bit disheartening to see these types of things going on. Mr. Dan, anything to add here for J3 Dingle, who says, all these record fines, he agrees with us, but it's kind of just the cost of doing business for them as they head to their inevitable IPO.
Oh, yeah. I mean, I would love to sit here and say, J3 Dingle, that's such a cynical way to look at things, but is there another way to look at things? I don't know. I was waiting to hear about the Reddit kids deciding to, boycott or short Robinhood stock or something like that. That would be
that would be interesting if they'd have like a massive just short-a-thon on Robinhood and they drive it down to like $5. That'd be interesting. That'd be a nice little comeuppance.
That would be like if this were a movie franchise, that would definitely be the sequel.
You're right. It'd be the Wall Street Bets, The Revenge. We'll get those guys back out there. Same people who are putting these billboards, rolling billboards in front of a Citadel HQ that could be mounting that campaign next. But yeah, unfortunately, it's a cynical outlook, but it is kind of the world we live in right now, J3 and everybody else. I knew this Robinhood discussion would unleash quite a bit of opinions, and it has. Well, let's keep on rolling here. This question comes from Jason Cruz. He says, hey, boot camp. Oh, he includes a waving hand emoji. Well, waving hand right back at you, Jason. He says, if I've got a put credit spread strategy working well, am I missing an opportunity by not tacking on a deep out-of-the-money call kicker? I think you mean a far out-of-the-money call kicker, but it's all right. I'll allow it. Deep in the money, far out of the money. But I digress. So by not tacking on a far out of the money, call kicker for an iron condor, since I'm posting the margin either way. So Dan, sounds like Jason's out there selling put credit spreads. We've gone down that rabbit hole of credit spreads in the past. We won't revisit that. But he's been selling put credit spreads. Sounds like it's working out. He wants to know if he should tack on a far out-of-the-money call kicker for an iron condor, he says, since he's posting the margin either way. Well, if he's selling an out-of-the-money call now, again, he's gonna be tacking on a wee bit more margin, Mr. Dan. What are your thoughts on that?
Well, I mean, here's the thing. The put credit spread has I don't want to say directional component. I mean, there is. It's a positive delta, but basically you can only lose if it goes down. And so, if it goes up to the moon, then you're fine. So it is a little bit of a different thesis, I would say, where, if you do the deep out of the money call credit spread, now you can lose to the upside as well. And, that said, too, if you're far out of the money, a lot of times you just don't get enough premium, too, especially on the call side, because since we've been talking about Skew this show, we know that the call volatility is typically lower for most equities. So, there are definitely times when I would do that, but it's situational. Am I purely direction neutral? Am I getting enough for that call side? Those are the two questions that I really want to answer.
All right, yeah, I definitely like it better as, a call spread out of the money. In that case, it would be an iron condor. He doesn't specifically say that. He says he wants to just put out a deep out of the money call kicker. If it's a call out of the money call spread, and then therefore you are transitioning into an iron condor, I do like that a lot better. You made it sound like you were just doing naked out of the money calls just for the hell of it. And if that's the case, you're going to have a hell of a lot more margin added into your account than you have for just whatever put credit spread you're selling. So if you do see, if you like the premium on it and you're doing it in some sort of risk mitigated fashion, aka a call spread versus just a naked call, then yeah, have at it. I don't see a reason against it unless you're just, throwing good money after bad out there. But if you like the levels, you're attracted by, you think they're worth the risk, then by all means, have at it. I'm not averse to iron condors if they're set up well. But interesting stuff here. Unfortunately, Dan, that music means we've already gone beyond our allotted time. So if folks are intrigued, maybe they want to hit you up about adding call kickers to put credit spreads or the Skew index or Robinhood or anything else that's going on out there, Dan, where should they go? What should they do? We're
glad to help. Just you can message me at markettaker.com. It's market like stock market. Take what is rightfully yours. 2 T's in a row. Markettaker.com. Just hit us up on the contact us page. We're glad to help.
There you go. Markettaker2Ts.com is the place to go. On behalf of the Black-Hatted One and indeed myself, I want to thank all of you out there for downloading, streaming, and subscribing, listening live. Remember, all you pro folks get bumped to the top of the list. I see you in there, Nichols. Hello to you as well. Glad to see you. Glad to see you live. Yeah, I know you've been sending a lot of email questions of late. Glad to see you actually live in the chat there. Glad to see you're enjoying. You could join Nichols and everybody else over there in the live chat on the pro side. Listeners, if you're on the plus side, you can, of course, join in there as well. Where do you go to learn more about that? TheOptionsInsider.com. You can just go to /shop. That shows you both of them as well, so you can compare and contrast, or you can go to /pro or /plus. Whatever floats your boat. And, of course, we'll see you back here just later today. All you pro folks, later today, back with the Spikes Father in less than an hour now. The clock is ticking for your second pro Q&A. Man, this is a mad extravaganza of Q's and A's out here. Glad to see so many of you are enjoying it. Then, of course, we're back again next week, another episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.